Okay, welcome everyone to our lunch and learn here. We will. I'm just going to pass it right over to Gary Lipski from Break of Day Capital, and take it away, Gary. And also, just before I pass it over, I guess I should have asked: are you okay with questions in the chat if people have them, or you want them to raise their hand? However you want to do it is fine with us.
You know, I might not see the chat because it kind of goes down, but I welcome anyone to just unmute and just ask away. This is for you guys, so happy to answer anything that you throw at me.
Perfect. And if something shows up in the chat, I will be sure to wave my hand and let you know.
All right, sounds good.
Thank you, Gary.
All right. Well, welcome everyone. Thanks for joining us. I'm going to speak on asset management for the passive investor. And I'll tell you a little bit about myself. So president of Break of Day Capital, based here in Los Angeles. We focus on value-add opportunities in Tucson and Phoenix. We have over $102 million assets under management with another $96 million in the pipeline. I wrote the best-selling book, Best in Class, about asset management. I also have a real estate asset management podcast and hosted a summit based on asset management. So really focused on that. And that came from just years and years of being an entrepreneur and running businesses. And so when I found my way to multifamily, that was an asset that I brought to a team when we took over properties and things that I don't know. I kind of leveraged my podcast and book too to keep asking other friends, other things that helped rev up my my knowledge base. So yeah, there's a book, there's the image of the podcast. So asset management, people get confused with, or at least newbies do, between asset management and property management, and they're very completely different. So typically, an owner operator will hire a property management company. Some people do property management in-house, but it's until you really grow to scale, it's really hard to do, and it's a thankless, low margin job that requires plenty of staff. So we chose not to do our own property management in-house, and a lot of people ask me that, why not? And it allows us to be better operators in one viewpoint, because we could be nimble and not have to stay in one market. Now we focus on one market, but if the market dynamics changed over time and I had to move to a different city where I felt there was a lot more value, I might not do that because I built up this huge property management company in that one area. So it allows you to be a little bit more nimble. And the property management company that you hire, they don't own the property. You own the property with your investors. So there's a different level that you're going to get from an asset management standpoint versus a property management standpoint. And now there are ways that you can motivate your staff, and it's not just money. You've got to find different ways to make them motivated. One of the things that we did at a property is the property manager was a big Chiefs fan, and my partner on the deal was a Raiders fan, and those two teams do not like each other in the same division. So we started joking one week in our property management calls that if we hit 100% occupancy, he would have to wear a Chiefs jersey, and we were probably sitting about low 90s in our occupancy, and this woman never worked so hard, and we got to 100% occupancy, and we've been fighting to get there for months. And not really 100% occupancy is our goal, because we want to be able to keep pushing rents, but she was so excited to get there. We showed up, and she had a Chiefs jersey, and we took a picture, and no amount of money could have motivated her. But you find different ways to get get them to have that ownership feeling, and that's really important. So, property management handles the day-to-day, and you're more at the 30,000 foot level, worrying about business execution and going through all the reports and the financials. So in that respect, you're managing the manager. Every week we have our call on Zoom, so we can see each other. Even if the property is performing really well, we still have that call. It could be 5 minutes long. And in the beginning, it's much longer, but it's really important to have that time, to be able to ask, how everything is going, even though you have your report, and we'll look at that report and go over it ahead of time, so that I know the right questions to ask. Occupancy, vacancy, where we are with renewals, where are leads coming from, how are the turnover of units, evaluating that stuff ahead of time, so that I'm using my team's time the best during that call. Also, as an asset manager, really key is the business plan execution. So you form that business plan during due diligence, and you go over it with your property management team, because if they don't agree, it's going to be really hard to execute that business plan. So you gotta make sure you're all on the same page, and you got to monitor it, because they're not going to move, they're not going to push as fast as you will want them to. So you've got to stay on top of it. You also got to, as an asset manager, go over financial analysis. You're getting 100+ pages every month, probably around the mid-month of the previous month, and you've got to go over it with a fine-tooth comb. There are going to be mistakes in there. It's human nature. An accountant for a property management company may have 10 properties, and I've seen it where they put a $5,000 charge in the wrong place, or a staffing to the wrong property. It does happen. So you've got to, when you invest with someone, you've got to make sure that they are going over the financials monthly, really closely. And when we talk to our property management company, most operators don't do that, because we are definitely, putting them through the ringer a little bit when we go over, and asking a lot of questions. Usually there's a good answer. Sometimes there isn't, and when there isn't, then we delve a little deeper and fix the situation. Also, asset management is investor communication, and you'll kind of get a feel for that, when you talk to a sponsor. How quickly do they get back to you? Do they give you all the information? And it may change if the property isn't performing well, and that is a huge red flag. Obviously, when COVID hit, we doubled our communication with the investors. We want to make sure that, we're telling them the good, the bad, and the ugly, and on a consistent basis, because they're nervous. They put their hard-earned money into a deal. So there are often times when things go bad, operators don't communicate as well and hide. And investors have told me stories, and it's really disappointing to hear. And so I would ask, when you're talking to syndicators, and this is a great forum, left field, because you're able to network with people and figure out who are the better operators versus not. And it's great to have that kind of group. But if you're talking to a new sponsor that you haven't dealt with before, ask them to speak to some of their investors before you invest with them, and ask their communication style, and if they actually do communicate tough times, because quite honestly, nothing goes perfectly planned. You don't know when a Texas freeze is going to happen. You don't know when COVID's going to happen, or a fire, or this or that. I mean, stuff happens, and you do enough of these, and you'll over time you'll encounter lots and lots of issues. And there's ways to mitigate that, and being proactive, being ahead of your business plan, and solving problems. I mean, that's a lot of asset management: herding cats and solving problems. It's certainly not the sexy part of things. People love to post, hey, we got this deal, and we've got X amount of return. But it's that day-to-day hard work of asset management is a huge differentiator. I was having dinner with a potential investor last week, and he was talking to me, or telling me about some sponsors that he felt have left over $1 million on the table on how they handled extra income lines and stuff like that. And the syndicator said, well, we're hitting our 16% projection, but a really good asset manager will go that extra mile and make that 16% be 20%, 25%. Okay, curveballs, pivoting, that is so important. There are many times in our properties where we'll change our business plan as it evolves. So one property, we renovated almost all the units, and we're maxing out our value add. So what we did was create a platinum unit, really 5, just to prove it out, and created a little bit more value for the next buyer. People love to purchase value add deals, and so we created that meat on the bone for someone. And so that was a pivot. We put a little bit more money in, and having plenty of cash reserves is really important, because then you can make those pivots. We decided to paint a property when it really wasn't in our business plan in the beginning. That was $160,000, but again, we had those reserves, so we were able to pivot. And then asset management is deciding the right time to dispose of a property. And there's a lot of things you need to do before that. And what we do is, every year we'll talk to a broker and kind of get a feel for the value of the property. They could do a BOV, and also buying and selling in the same market. We kind of get a feel for the market too. But you want to position your property the best to maximize the return for investors, and that takes some handiwork. All right, so a good asset manager makes a good deal great, makes a bad deal good, and you'll see that. And asset management, I think I said this earlier, it's more important than ever as we get to rising interest rates. And what does the reversion cap look like on deals that you have already invested in? A good operator will navigate that and have plenty of reserves and have a good conservative reversion cap. But some operators that were chasing deals are going to have a problem over the next couple of years. I don't want to go down this road too much, but I really don't see, at least for multifamily, it taking a hit, because we're over 5 million housing units short, and if you're investing in growth markets, it makes you look smart. You're able to ride a wave and still perform well. But again, you still have to have a quality asset manager, and not chase yield. You want to chase the best jockey, quite honestly. A good asset manager will also see issues before they happen. So, what we bought a student housing property and converted to multifamily, and so we had all of our leases expiring at the end of it was the end of June or end of July. So obviously we knew that issue was coming down the pipeline, and anyone that wanted to leave early, we were happy to get them out of their lease and start renting apartments and doing 6, 9, 15, 18-month leases, changing it up so that we're spreading our renewals over the course of the year, not having it, the following year all, having a lease up at the same time. And that's just one example, but a good asset manager will see issues before they happen. And obviously, it's protecting investors' capital was the most important thing. Growing it is the second most important thing. And like I said, if you guys have questions, feel free to jump in. I'm happy to answer any questions. So property visits are so important. What we do is many times we go unannounced. We don't tell them, hey, we're coming by, and you can get the property looking as nice as you expect it to be when we're there. We want to see how they perform when they don't know that we're there. And also that means checking it out at night. It's not just during the day when it's convenient for us. We want to see how well it's lit. Are the lights working? Because there are many times I went to one of my properties, the lights kept not working at night, and it was very frustrating. But the only reason I knew was because I was going there unannounced and kept asking my staff to fix it. And eventually we did get it fixed. We secret shop our properties too. So what we'll do is I'll have my assistant, she'll come up with a different email address or phone number and call and email and see how quickly they respond. How do they answer the questions that she's asked? Do they follow up? That's really important. Like I said earlier, weekly calls with the weekly reports, having that consistency. If there's, Memorial Day, then let's move it to Tuesday. That consistency is so key. So we're not losing track. Because each week we can manipulate where we are with the rents based on occupancy. And so that call is so important. We also have access to the property management software. So you want to make sure anyone you invest with has that. This way you can see the reports live and get access to whatever you need. Like I said, those monthly reports are really key. Going over it with a fine-tooth comb. Certainly, when I started, I wasn't an expert on going through those monthly reports, but you just ask questions, keep asking questions, and having that data so you can track it. A good asset manager will have that data for properties that they're looking at in the future, because they've got that baseline from previous properties that they own, and be able to make better decisions moving forward. All right, so I like to use the word map when I'm thinking about asset management, and so that breaks down to measure everything, having accountability, and being proactive. And I'll show you some of the things how we measure everything, and the accountability and the proactiveness. All right, so with the measure everything, it's tracking. So Google Drive is free, and so our weekly report is on there, and each week is a new tab, so we can go back and see what was done last week. We could see how we performed a month ago, a year ago. All that is on that Google Sheet and in the Google Drive for everyone to see. We also use Trello, and we use that a lot for our renovation, so we can see where our units are at each stage of the process. And this way also for the renovation team. So we'll make sure we have everything they need ahead of time, and we're not waiting. And they're notified whatever it is when they want to be notified, 2 weeks, a month before, because we'll know a unit will be vacant. So making sure everyone is ready to go the day that person moves out, so we can reduce timelines. And that's always our goal, reduce timelines. If we could save a week on unit renovations over, 100 units over the course of the year, that's a lot of money by being able to rent that unit that much faster. And then you divide that by the cap rate, and we're talking hundreds of thousands of dollars of value that you've created for your property. We also have a CapEx tracker, which I'll show you, and we share that with our investors on a monthly basis. And it's so important if you're not keeping track of your CapEx, because that money will burn through fast. And then if you're not keeping track of it, you're not going to be able to pivot like I talked before. And maybe you have to dip into your cash reserves. It gets ugly fast. So you want to make sure you're keeping track of every single expense on the CapEx. And then obviously you want to have your KPIs, and I'll show you some of the things that we do. So this is a tab that we have in our weekly report. There's a project or task, the details of it, who's responsible, what is the target date, and when it was completed. So this is for everyone to see. People tend to write notes on a piece of paper and then lose that paper. But having that on Google Drive, someone could go back and check it. I don't care, even if our call is at 2 p.m. on a Monday and they check at 9 a.m. and realize what they have to do, there's a much greater chance that they're going to get it done because it's there, and they're going to be called out at that meeting. So it gets things done. It's a good way to hold people accountable. This is our CapEx tracker that we show investors. It'll in our monthly report that we send them, they can click on a link and see where we stand as far as budget and actual and difference. And some things end up costing more, some things end up costing less. We always like to put a little bit of buffer in there. And then at times, we'll add some things that we didn't necessarily think about beforehand. We try to think of everything, but there's, as things evolve. So having it tracked is really, really important. And you as an investor can see how we're doing. We'll go into more detail on our tracker, tracking every unit, what it costs, square footage. The exterior rehabs we'll do a little differently because it won't be per unit; it'll be based on invoices. Lots of KPIs we look at. We like to break everything down, and this way you get a lot more detail. So here, when we look at it, we see vacant at least 50% on the right here, A2 R1. Now there's only 4 units, so at 50%, I'm not that concerned. But what I will look at is why that is not performing well. Maybe it's a little location, maybe it's just a little too high. So for the most part, I can raise pretty much all these other units because of where we are on our occupancy, but that unit, maybe I drop $15, and if that doesn't get it done, maybe I drop it $30. But I don't look at it as a whole. You'll want a sponsor that breaks down every single task and sees where the bottleneck is. Here's another one that I really like: traffic conversion. Here I got apartment guide. That's a tremendous amount of traffic, 208. But I mean, likely that's the wrong traffic, because look at my conversion ratio on the right. But Craigslist, it's a very small sample size with 16 traffic. But I got 4 move-ins, just as much as apartment guide. And typically, Craigslist is free. Maybe you spend $25 per listing. That was a 25% conversion rate. So I'm gonna focus more on Craigslist for this property based on these results and see, hey, does that, if I can rev up my traffic, am I still getting the same amount of move-in? So we want to keep breaking everything down and test things, because if I'm spending $1,000 a month on an apartment guide, maybe that's not the best way to go for me for this property, because every submarket is different, every city is different. Some cities, Facebook Marketplace is a great way to get, and it's free to get residents. In other places, it doesn't work nearly as well, and things constantly changing as well. So you've got to stay on top of it. You got to keep looking at it. Just because something worked last month doesn't mean it'll work next month. All right, so like I said, being proactive is super important. This way, you're way ahead of the game. And when COVID hit on one of our properties, we were way ahead of the game, so we were able to sustain it. Another property we had just taken over, and we had some. It was a rough tenant base, so we weren't ahead where we wanted to be. So we had to take some lumps, but again, we were proactive as we could. We introduced some new things to the market that they weren't used to. So living in LA, you do cash for keys to get people out sometimes, so you can raise the rents. But and this property was in Phoenix, and they had never done anything like that. Our property management company. And we suggested that, and it worked to a small extent, but it was still another tool for us to use to get non-paying people out and getting paying residents in. So you gotta, a good asset manager will be proactive. Like I said, measure everything, break it down to find your bottlenecks. When you don't look at unit renovations as a whole, like, oh, it takes 4 weeks or 5 weeks to get it done. I want to see each step of the process, how long it takes. And so maybe I could find out, maybe we didn't order the kit in time, so that they have the sink, the handles, the cabinet, whatever they need, they have it in advance and they're not waiting. So measure make sure whoever you invest with measures everything. CapEx, keeping track of the CapEx is critically important. And setting expectations up from the very beginning is really important. And we won't necessarily share our business plan. We'll talk about some ideas, but I also want to hear from the property management company, what's their business plan, and go over our expectations, which is it's about speed, quite honestly, and letting them know what I expect, because I will be harder than most other operators on them, but I'll also celebrate their wins, and I'm going to speak the truth. I'm not going to beat around the bush, and if they know that going in, we're going to get along a lot better. They're gonna they're gonna reach to my level, and so setting that up where their target is up front is really really beneficial. And good asset management really starts after due diligence. Once it's once you go through due diligence and it's all systems go, and it's getting everything ready for the takeover and implementing that business plan. So to conclude, really know your sponsors, and this format, Left Field is fantastic for that. I made the mistake, and I know plenty of others when they started out, just started investing with people that they know, or they had some kind of forum. But just because you know them and they have a forum doesn't mean they're a good sponsor. So really get to know your sponsors. How is the asset managed? And ask them how their other assets performed. And not every asset is going to have performed fantastic. I mean, hopefully it is, but if it isn't, talk about the things that they learned and how they managed that. Did they have a capital call? How was their communication? Those are critical things to understand. Yeah, I just mentioned communication. Yeah, communication is key. How they communicate. Do they communicate when things are not going well? And that happens sometimes. So that's really important so that from some of their other investors how that communication style is. Do they get back to you right away? Does it take a week? Do they answer your question the first time? Are they accessible? No matter how big an operator is, an asset manager is, if they're not getting back to you in a timely fashion, that's, maybe they're not right for you. They're not right for me. Maybe they're not right for you. And business plan execution, that's critical. Making sure their monthly reports, they are executing on their business plan. And also check their track record and experience. Certainly there's newer sponsors out there, but have they run a business before? There are other things, other experiences they could have had to make them a better operator than maybe someone else because of they've run businesses before or whatnot. So get to know what they've done previously and their track record, and then you could make your decision from there to invest with them. So here's my information if you want to reach out, but I just downloaded a lot of information, and I'm happy to answer any questions you guys have about multifamily asset management. So unmute, shoot away.
That was great, Gary. Thank you. I'll ask the first question, and it's kind of a broad one, and I know you covered some of it, but how do you evaluate the asset management capability of a sponsor before investing? Because I think it's a little bit different than just our typical, we're analyzing a sponsor, you're digging a little bit deeper. So we're all passive investors here on this call. So how do we really dig in and ask the right questions that get us to the asset management part of being a sponsor?
Yeah, that's a good question. So I think looking at some of their past monthly reports on properties is really important. So you could see, are they just giving you the best information? Are they breaking down unit turns? So unit 104, previous rent was 900. Now they're getting 1,300. Are they giving you the CapEx tracker? What information is in that monthly newsletter? And you can ask for a few months so you could see how their reporting is. That's really important. You'll also get a feel for it in their presentation on properties. Are they delving deep as far as the information they're presenting to you, or are they really focused on returns and making it look good and this and that? Because it's, again, it's not really the difference between a 15% IRR from a good operator and an 18% IRR from a not so established IRR. Like, I would invest with the 15% IRR all day long because I know my money is going to be safe. So, asking their experience and asking, being in a forum like this, and also seeing who else, other investors that have been invested with them, and ask them those tough questions too. I get a lot of newbie investors with me ask, hey, can I talk to some investors? And I'll gladly share that information out. So if they are reluctant to do that too, that's not a good sign.
Excellent. Thank you. Are there other questions? We'll wait here and see. Oh, here's one. Has asking for references been valuable as a due diligence question? Obviously, the sponsors will only want to provide cherry-picked ones.
Yeah, and I learned this from someone else when I was just starting out. Because I was an LP when I just started out too, and I still do some limited partner investing. Once you talk to that investor, ask that investor, do you know of another person that's invested with them before? And so you're going further down that food chain and seeing, you never know if that person's going to send what that sponsor feels is someone that is a friend or not. But, feel free to ask that question,
Yeah, we had I forget who was it. I think it was Ryan Gibson from Spartan. We were talking to him, and one of the things he said that I really liked was when he asks for referrals from the sponsor, he's very specific. So he says, give me someone who's invested in, 70% of your deals. Give me someone who has only invested once, so I can ask them why maybe they didn't invest again. And give me somebody who invested in a deal that didn't go as well. And so by that, you're avoiding some of this on the, where the sponsor's just giving you their best choices. So I like that as well. So I think that's all. If ask for referrals, but if you do it in the right way, you might, and I like also talk to referral and then ask for a referral from your referral, because then you're getting away from the sponsor a little bit. That makes sense to me as well. That's a good idea. Other questions? While people are thinking, I have another one, if you don't mind. I don't mean to capitalize on all the questions, but the market's changing. I think, a lot of people are saying anybody could make money in the last 10 years. So when I'm evaluating a sponsor and I'm evaluating their asset management, what do I need to look at, knowing that we might be going into a period of time where it's not quite as easy? Like, I was an asset manager on some multifamily and I was horrible at it, and I made money, right? That's not going to be the same 5 years from now. So how do you analyze that?
Yeah, and I think it goes back to those monthly reports, and asking them, how are they working with the property management company? Are they doing the weekly calls, and hopefully being on a Zoom where you could really see the person, quite honestly, because most people are going to talk a really good game. And they don't necessarily do what they say they're doing. So, and I'm not trying to be like negative or anything, but I mean, there's obviously really good operators out there, and then there's a lot of, mediocre to bad operators that, like you said, have done really well in a great market. Heck, I've looked really, really smart too, So it's asking those tough questions. It's kind of reading between the lines. It's seeing, did they maximize the value of that property? Because on some of the deals that I've invested in, and I'm, and they're selling now, and I'm seeing, after 3-4 years, 1.6x return, and I'm like, geez, that they did not do a good job, because in these same markets, I'm seeing 2x return in that same period or more. So you can, if you look at enough deals, and you could compare, what the results have been, and get a better feel for if someone's performed well or not.
Excellent. We have a question from John. Once you know, like, and trust the sponsor, how important do you think it is as a passive investor to dig in really hard to the monthly reports and dig into the details?
That's a good question, John, because I we'll end up doing quarterly Zoom calls, and for our investors too. So it's a different touch point. And once we get a property, like performing well, like after, for the first one, we'll have maybe 50%, then the second one, 25, like it'll dwindle fast. People just ignore their passive investments, and it is important to stay on top of it, to see if they're not, each month is like not a different stat, they're just picking the best one, that they're staying along with that same, KPI. So you see it over time, and it's not just cherry picking too. So, it is good to know, like, and trust a sponsor, but, don't be afraid to look back 6 months ago and seeing the comparison and making sure, the pro forma they gave you in the investment summary, is it matching up to where we're headed? And is everything are they performing as well as they say they're doing? Because someone could paint a really good picture for you, and it might not be as beautiful as it is.
Yeah, and I think it's important initially, like you said, people drop off, which makes sense. I think it's important initially to really dig into those pretty deep, I think, because if you find some mistakes or you find something you weren't expecting, then you can kind of get on the operator and say, hey, what's going on with this? But if everything checks out and everything's perfect in the first 2 or 3 reports, then, okay, confirmation, maybe you don't dig into that one as much. So I think that all makes sense to me. We do have another question. It's a little bit off topic, which is fine. How do you see the multifamily market changing as interest rates increase, including cap rates?
Yeah, there's definitely a softening. I mean, I've got 2 in escrow to purchase. I've got 1 in escrow to sell and another one on the market. So seeing it both sides. One thing to make sure is when you're investing with an operator and they're doing bridge debt, make sure that SOFR curve is built into their model. And then they obviously buy a cap rate, or they have that reserve. But I still remain very bullish, but conservative in my underwriting. Like I said before, there's such a shortage of housing, and if you're investing in growth markets, that's key. Now, certainly, I do feel that there's opportunity everywhere, depending upon how you underwrite. If you're investing in a market that's really flat on population growth, then you have to be even that much more conservative. Now, I don't do that. That's not my thesis. I'd rather invest in pay a little bit more, but in a growth market, and it allows me to kind of ride the wave even more so. But I don't see interest rates skyrocketing as much as they say. I think the Fed is trying to scare inflation in the markets. And I don't see cap rates dramatically increasing. I think they've gone up about 50 bips in the markets that I'm investing in. So I'm still bullish. Everyone needs a roof over their head. I think multifamily is a great asset class, but you do have to be a little bit more conservative in your debt. Make sure you really understand your debt, and how it will look if you're doing bridge, and if it's three years, what's the yield that the lender has to achieve so that they renew, they can extend the loan, versus forcing an operator to sell. That's a key point, and I see more investors asking that question. But a good operator is going to find good opportunity out there and continue to provide great returns for investors, and it's a great place to put your money.
All right. Another question from Daryl. Should the LP expect to have direct access to the asset manager to ask questions, et cetera, as opposed to the investor relations person? Would it be a red flag if you only get communications from investor relations?
For a bigger company, I don't think that is necessarily a red flag. An asset manager, might not communicate directly, and might not be a good communicator, quite honestly. And that's where the investor relations person comes in handy, and that's their job. So I don't necessarily think it's a red flag, but if you don't get the information that you've requested, or it takes, a very long time, then that is a problem.
Excellent. All right, we'll pause here, see if anyone has any other questions. These have been great questions. So if you have one or I missed one, let me know. You're also more than welcome to unmute to ask questions. And if not, we will close here. So I'll just wait just a second. All right. Well, Gary, I do want to say that this has been great because I don't think asset management is something that we talk about very often. I mean, we've been talking a little bit about it more now, but everyone always talks about how do you find a sponsor? How do you find a great sponsor? How do you qualify a sponsor? But we never really define what that means and what does it mean to be a good sponsor. And I think you nailed it, because what it means to be a good sponsor is to be a good steward of the asset, right? You're the asset manager. And I know from my experience on small multi and turnkey, I was horrible at it. And really, it was just managing the property manager. And I did a horrible job. And that's why I went into being a passive investor and having other people be the asset manager for me. And so I think you did a really great job of explaining some of the tasks and some of the things that an asset manager has to do. And that in turn allows us as passive investors to really dig in and ask some of those questions. Like some of those reports, like the CapEx report, that's fantastic. I'd love to see that because it gives you an idea of how they estimate things and how it turned out. I was just looking at the completed section. It was great. So we really appreciate your time. I'll give you an opportunity here to close and tell people how they can get in touch with you if they want to learn more about Break of Day Capital.
Yeah, I appreciate it. And yeah, every property is running a business. And if your operator isn't thinking about it in that way, that's a real problem. But, thanks for having me on, Jim. Really appreciate it. And if you guys want to learn more about what we do, just head over to our website, breakofdaycapital.com, and you could sign up for our newsletter. You can see offerings. You'll see a link to our podcast and social media. So all the information is that's the best place to start. Breakofdaycapital.com, and thank you for your time.
Awesome. Thank you, Gary. And thank you everybody for taking time out of the middle of your day to come with us to the Left Field Investors Lunch and Learn webinar. We appreciate it. And we will see you next time. Thank you very much.